Advanced Financial Accounting Excel Practice Problem. In this presentation, we're going to be continuing on with part 2 of a practice problem related to a consolidation where we have a parent-subsidiary relationship, parent owning over 51% of the subsidiary, but not 100%. Therefore, non-controlling interest will be present, something we have to deal with. We will be focusing in on a situation where the parent purchases S bonds, so P purchases subsidiary bonds, from a third party at a discount. And so that means that S originally issued the bonds to someone other than the parent, someone not related, and they issued it actually at a premium in this problem. And then S came along and purchased those bonds that are S's bonds, the subsidiary bonds, but not from S. They weren't issued from S to P, not from subsidiary to parent, but from a third party. So they purchased them from a third party. When the parent purchased them from a third party, they actually purchased them at basically a discount situation, even though they were originally issued at a premium. So that's going to be one of the areas that we will focus on to get ready to account with advanced financial accounting. Here we are in Excel. We have our information on the left. We're going to be entering that into the blue area on the right. Now, we've started this in the past, so we've been entering some of the tables already. If you haven't done so, you want to go back and check those out. It's an excellent presentation, and that'll help us going forward, of course. Then if we go all the way to the right, we have our consolidation worksheet where we have parent and subsidiary. We have totaled those up. Our major concentration here will be doing the actual consolidation or elimination entries that we will enter here. The tables that we have put together will help us a lot to kind of verify our numbers as well as to construct our numbers. So let's go back on over to the left. What we're going to do first then is take a look at our normal table that we will use to adjust our first entry. So we're going to enter our first entry here. We're going to populate the first table that we typically use with some of the information we have put together thus far in order to adjust that first entry. So I'm going to go back on over to the left. This is our standard kind of adjusting type of table that we will use. We're going to start with the net income of S and basically the book value, break them out between the controlling, non-controlling interest. That'll be our normal beginning journal entry, which we will then adjust for our purposes here. Typical adjustments will be something that will be happening or have an effect on the subsidiary income statement related to the consolidation process. So I'm first going to take the total for the net income. Standard process over here for these consolidation worksheets. Here's S. The net income is down below. There's that 89,000. So we want to take that 89,000. We want to break that out between the controlling and non-controlling interest. So the 89,000 times the 75 controlling interest. Then we'll pick up that 89,000 times the 25, that being the non-controlling interest. All right, that's our initial journal entry standpoint. Then we'll make adjustments to them. We'll make adjustments for the upstream reversal. This is going to be related to the intercompany inventory transfer. Won't spend a lot of time on explaining it because we've seen these in the past and we spent more time on them, but you're going to get this number down below. This is a prior year inventory transaction, so we're going to be taking this as going to be a positive. It's a reversal, basically, transaction. That's going to be the 15,000. Now, because this is a upstream transaction, we're going to be breaking this out between the 75-25. So I'm going to say this is going to be the 15,000, 75 controlling, same 15,000 times the 25, that being the non-controlling. Then we're going to pick up the current transaction, which was the deferred gross profit. This is a down transaction. Once again, inventory transaction that we did in a prior presentation, or we put into this worksheet in a prior presentation. It's going to be a negative this time, or a subtraction, or reduce our total, 9,000. Because this one is a downstream transaction, we will not be breaking it out between the 75-25, but putting the full thing into the P portion, as we've seen in prior presentations related to inventory transfers and sales. Now we want to go to the new thing here, which is the amortization of the constructive gains. So it's going to be a negative or a decrease because it's a gain. We're going to calculate that. We calculated it in our table down here. Again, if you've missed that, you probably want to go back and pick that up. I'm going to take that. I'm going to divide it by the number of periods, that being 8. So it's going to be the 494. There are our adjustments. Okay, let's sum these up now. Summing this up, first column. Summing up then the second column. You can obviously copy and paste the formula, but I just want to emphasize that we're summing up each of these columns. So there's our starting point. Now we're going to do the other side of the transaction, which is basically going to be to the net asset side of things. So we start off with our net assets, and then we'll enter the same information we had up top. So we're going to say net assets can be calculated as assets minus liabilities for S, which would be the 268,000. We'd get the same number if we were to add up to the equity at the 268,000. That's going to be our starting point. Let's do that with a formula so that you can see that even if you're just looking at this Excel worksheet without me talking through it. So we're going to then say the total is going to be the sum of S column here. The sum of the S column. Sum of S. All right, so that's going to be the 268. We're going to break that out between the 75/25 controlling and the non-controlling interest. So there's the 75, and then we're going to do the same thing on over here with the 25, picking that up times the 25. Then we're going to be picking up the same kind of filler. So same information in the middle, kind of like a transaction, kind of like a journal entry, because we're doing this to make a journal entry. There's the 3,750. Here's going to be the 11,250. And again, I'm doing this with journal entries. You can copy and paste them, but I'd like to see the transactions so that you could see them when you are just looking at the Excel worksheet. Now, notice this one I didn't allocate out over here. I should have. I should have allocated it out by the 75/25, so I'm going to do that now. 494 times the 75. And then I'm going to be picking up the 494 times the 25. There we go. Then we're going to be picking up the 124, the 371. I'll sum them up this way for our kind of double check numbers this way. See if they come out to the same number as they should. Equals the sum. So we should get our same numbers here and here. That looks right. Now let's sum them up this way. Sum up this way, tab, sum up this way, tab, and then sum them up this way. All right, so there we have it. I think that looks good. That looks good. Okay, so now that we have done that, let's go on back over. And before we do the consolidation entries, I do want to look at the transaction related to the interest for the bonds. We want to concentrate in on these bonds. So in other words, I'm going to go back to the left. Going to scroll down to the bond transaction. That's these two transactions here. And we had the original bonds that were issued by S of the 190,000. There was no problem when that happened. And they issued it for 8%, 10 years, 104 at a premium. In other words, they weren't issued to P at that time. But then P came along and purchased 76,000 of the 190,000 bonds. That causes a problem. They purchased it as a discount. So now let's think about, well, what's going to be recorded basically with relation to this portion of the bonds that have been recorded, because we're going to need to, in essence, reverse those. So that's what we're concentrating in on here. So let's start with P's side of things. So let's go on over and start with P's side of things. Now, they're going to be the ones receiving cash on the bonds. They purchased the bonds. So they're going to say cash. What would have happened? We're not going to post this. We're reconstructing basically what is already included in the numbers for P and S related to the basically intercompany or related company bond transaction. They would have recorded cash that should have been received of the 76,000 times the 8%. So they should have got 6,080. Now then we're going to record the investment in the bonds. So the investment in the bonds is here. Notice the investment in the bonds is on P's books because they're the ones that purchased the bonds. And then on S's books, we have the bonds payable. They're the ones that issued the bonds. They have the bonds payable and the premium over here. So with the purchase of the bonds, they purchased them for the 74,860, and it's got to go up to the basically the face amount of the bonds that they purchased. So they're going to this would be similar to us kind of if we were looking at the other side, we would be amortizing whatever the premium or discount. So this is a similar concept there, of course, that we've seen that in the past. So we're going to be taking that that adjustment then will be, we actually calculated it down here, so I'll pick it up in the table that we've done this in. That's going to be this discount. So you can take a look at the calculation of the amortization, the 190 of the discount. Now they recorded a discount, which again seems funny because it was a premium. When S issued them, they issued it at a premium and they bought it as a discount because they bought it from a third party. So it confuses things a little bit. So then we're going to say then the next account is going to be the interest income. So interest income, which we have interest and other income. That's the account we got. So we're going to sum this up, and there we have it. So that's basically what was recorded on P's books related to these kind of intercompany transactions. Now let's look at S's books, the issuer. We're not looking at all the bonds they issued. We just want to look at the ones that are going to cause this intercompany kind of problem, with a proportion of them that are causing this problem that we'll have to reverse. I'm going to start it with cash, and the cash transaction is going to be the same, even though the credit's on top. I'm going to put it on top so we can mirror what is happening. Now, the disturbing thing is this second one's not going to mirror like we would like it to, like it would have done if we were to, if they issued bonds from one directly to the other instead of purchasing from a third party. So I'm going to have to say, all right, then the premium, we know that we're going to have this premium that's going to be affected, and that's going to have to go down. The premium's going to have to go down with a debit. So how am I going to calculate the premium? And the annoying thing is it's not going to be the same amount as the discount. So we got to say, all right, well, we calculated the premium over here at some place. We said, all right, this is the total premium for all the bonds, the 190. And then here, this is a ratio of the bonds that have been purchased from a third party by S. So in other words, these are the bonds. If I took 76,000 over the 90, 40% of the bonds then are these intercompany bonds now. So of the total premium, 40% of them are going to be accounted for here, are going to have a problem with this intercompany type of thing. So I'm going to say 760 times the 40%. And there we have it, the 304. Again, very disturbing that these two don't mirror exactly, but that's the problem. That's the nature of this because that third party transaction. Difference here, then going to the interest expense, which we have down here in interest and other expenses. So we're going to take a look at these. These will be in play once we go down and do our elimination entries. Now let's do our actual elimination entries. We're finally here now, and we're going to use some of the table information to help us out and confirm some of these balances. We've got the parent, subsidiary, the total. We're going to enter the elimination entries here. We're going to start off with the elimination entries related to the equity section. So let's do those. To do those, let's look at our table over here, because we made a table to help us out with this first one like we've done in the past a few times. So here's our table. I'm going to hide some cells so we can look directly at that table side by side. So I'm going to hide from I. I'm going to highlight from I on over to X. I to X. X. And then I'm going to right click the selected area and hide. And there we go. So now we're going to say, all right, what's our standard kind of journal entry we do? And the first journal entry, I usually start with this one, even though I'm not going to put a number in it yet. Then we're going to go to the equity for S, basically removing equity for S, which will be equal to the common stock that we will remove. There's nothing in additional paid in capital, so we're going to be removing retained earnings as well. So let's go on down to the retained earnings. And then we'll do the same for the dividends. I'm just going to copy and paste them. So then we have the common stocks as a credit. We're going to do the opposite thing to remove it, which will be a debit. Debit of the 40,000. The retained earnings is on the books as a credit. We're going to do the opposite thing, a debit, to remove it. We'll remove the retained earnings. The dividends are on the books at a debit. We're going to do the opposite, or a credit, to remove the dividends. So we will credit then the dividends. Next, we typically go on down to the income from S. Now this one, normally the calculation is going to be that 89,000 times the controlling interest. So normally it would be net income times the controlling interest, which would be 75%. And we could see that on our table. That would normally be that one. I'm going to make it green. I'm going to make this green. We'll color code it, but now we're going to change it to that. So I'm going to say this has changed due to our table from this to that. Then the next thing we normally do is the non-controlling interest in net income, which would be that's the other portion, the 25% of that net income. So that would be the net income of the 89,000 times the 25%. which would be the 22,250, which would be this number. But now we're going to change it to that number. This to that is what we're doing. So I'm going to say that's what I would have done, but now I'm going to say it's going to be that. And then we would normally do our non-controlling interest in the net assets here, which would typically be calculated as the sum of the assets minus the liabilities times the non-controlling interest, or 25%. It would be a -2, but I won't do it now because we're going to change it. That would be this number. And that's what it would have been. That's tying out, but now we're going to change it to that number. So I'm going to make it that number. So that's this blue item, indicating that it's going to be something different. I'm going to make net negative of this number. And there is that. And then the other side normally would go up here, negative sum of assets minus liabilities times controlling interest, 75%. That would be the 201. That's what it would have been. It would have been that, but now it's going to be this. So we're going to change it because of our table. It's going to be changed to this. So there we have it. And you can see these middle numbers now. If I now highlight this, add up to the 273,506, and that 273,506 is going to be this number, right? Which we're now allocating out 75/25 in this format. So there's our starting entry. Now let's do an entry related to the cost of goods sold. So related to the cost of goods sold, this has to do with some of the intercompany inventory transactions we had. So let's unhide some cells. So I'm going to go from G to Y, JI, and then I'm going to right click on the selected area and unhide. JI doesn't mean anything. I just tried to say GY. Okay, and then we're going to go and say cost of goods sold. Cost of goods sold, I'm going to increase the cost of goods sold. It's going to be going up by, I'm going to be picking up the 15. I like to take the 15 from this table here. So I'm going to be picking up the 15 from this table. And then the other side is going to go into the two balance sheet accounts related to related to the controlling and non-controlling interest. So that's going to be the investment in S stock and the non-controlling interest in NA. We're going to break them out 75/25, and this should actually be a credit. So I'm going to cut and paste. I cut and paste, and then I'm just going to like format this back over, and then I'm going to make this a negative. I'll hit F2 and make that a negative. So negative 15,000 is all I did. And then I'm going to say negative this number times the 75% times 75%. And then this is going to be negative of that number times the non-controlling interest, which of course is the 25%, 75/25 breakout. Note that I put a subtraction problem here, and that left it at this 15,000, which is going to put us out of balance. You could fix that now by changing it. It should be multiplied, and this should be the number. You could change it now, or you could stick with it the way it is until we will make an adjustment for it shortly. So we're going to start to post all this stuff, and then once we do the second journal entry, we'll finally get to it and adjust it. So you can fix it now, or you can wait it out, and we'll fix it together. Let's go ahead and post some of these out, since I'm kind of not doing that. Let's do that. It would be nice. So the investment in S is going to be up top. Let's go in the investment in S stock. It's going to be equal to that 202,880. It's not zero yet, but we're not too concerned yet. We're going to go to the common stock then down below. Common stock. Similar, same scenario we've seen with the equity section. That being, here's P's, here's S, here's the total. We removed S, bringing us back to P. Then we're going to go to the retained earnings. So the retained, that's not retained earnings. Retained earnings is here. That's going to be the 160. Then we'll go on down to the dividends. So dividends will be here. That's going to be equal to. Similar process with all of these equity accounts. We basically removed the S side, bringing us back to what P has on the consolidated numbers all the way to the right. Then we're going to go to the income from S. Income from S. Looks like this is going to go all down to 0 right there. That's what we like to see, because we want it to be 0 at the end of the day. And it's 0 like at the start of the day. 1 is rounding. I'm going to call that rounding, so I'm going to say that's okay. So it's pretty much zero basically at the start of the day, which is even better than like having to wait till the end of the day. So then we're going to go down and say that non-controlling interest in NI. And so there we have that. And then non-controlling interest in NA is going to be the 70,627. That should put us back in balance. Now let's record this one that we just did. So that's going to be the cost of goods sold down here. Cost of goods sold. Let's record that. And that's going to be broken out between the investment in S stock. So something's in it. So I'm going to say F2 plus F2. 11,250, and then the non-controlling interest down here is going to be F2 plus F2. That's going to be the 15,000. So now I'm going to record the other transaction related to basically the inventory. Revenue is overstated, so we know revenue is overstated. So I'm going to say, all right, there's an overstatement of revenue, and that's for the current period transaction. So if I look at our worksheet, this is the little worksheets I do typically with the intercompany inventory transactions, intercompany sales or transfers. We have the 69,000 here, so the 69,000 is overstated. So we're going to pick up the 69,000 and we will then debit it. And then the inventory is going to go down. And this is where I like to pick this up from our table. So I pick this up from the table over here. And the reason I like that is because then now we've picked up these two numbers from the table. So I kind of just memorize that the inventory is going to go down. I memorize kind of like the format of this so I can pick it up from the table. So we've done the 15, we've done the 9 from the table. However, this needs to be a credit. And then the difference there is going to be going to the cost of goods sold. Cost of goods sold. And that's going to be the negative sum of these items. So that's to be the 60,000. Let's say revenue then. Revenue is going to be debited by the 69,000. The inventory up top, we're going to be picking up the inventory. That's going to be for the 9,000. And then we have the cost of goods sold. Something's in it, so I'm going to say F2 plus F2. And that's going to be the 60,000 there. And the cost of goods sold, something has gone wrong. Hold on a second. And up top, I had a subtraction here, and it should be multiplied. So I'm going to say times this number, and that'll adjust it. It's already posted out, so that should adjust it out there. Now we'll take a look at an entry related to the bond. So we're going to have to remove the bond information or the intercompany portion of the bond. So that's going to be including this investment account that we'll have to be dealing with, the bonds payable, the portion that says intercompany we'll have to deal with here, and then the portion of the premium we're going to have to deal with, and then of course the income and the expense we'll have to deal with, and we'll have to split out the non-controlling interest in the investment accounts. So let's take a look at those. So the bonds payable, we know that needs to go off the books. I'm going to say, all right, bonds payable, that's going to go off the books. Now, notice the bonds payable is on the books for 190,000. We're not going to remove the entire thing. We just need to remove the amount that's going to be intercompany related, that went one to the other. And so for that, I'm going to say we're going to have to debit to remove it. It's going to be the amount of, I'm going to go all the way to the left here, of that 190,000, the 76,000 are the amount that was intercompany. That's on the books at basically that face amount, because you're paying interest on it. So then we're going to say, all right, then there's this premium that we're going to have to remove related to the bonds. Now let's think about the premium. Now the premium, we can think of the total premium here, but now once again, we have to think about the portion of the premium that is related to the 76,000. So how could we do that? We could say, all right, let's do a quick little recap, a quick little recount of our data up top. We said that the premium calculation was equal to, I'm going to pull over this 6,080. And then let's pull over our percentage of that, which will be the 40%. That means that we're going to say the 6,080 times 40% is going to be the 2,432. Now, where did we get the 40%? Remember, that's the portion of the 76 over the 190 of the total difference. The proportion that is the ratio that is applied to basically the intercompany transaction. So then we have the 8 periods. We're going to be picking up the periods remaining are going to be 8. So then if we take this 2432 divided by 8, then we got the periods past, which are 2. Periods past are 2. So we're going to take this 304 times 2. So this is the amortization since the point in time that we started this thing. So the total premium allocated to this 40% portion was this minus the 106, means we're left with the premium that would be on the books that's related to this intercompany transaction of that 1,824. So we got to remove the 1,824 premium. So we're going to be debiting the premium. So I'm going to say this equals that amount. Okay. And then we're going to be removing the investment in the bonds. So the investment in the bonds is here. Now that should be fairly straightforward on the trial balance over here, because that would be the amount, it would be the bonds investment directly in the bonds to S. So we'd have to take that off entirely for the intercompany transaction. Whereas over here on this side, we had to take off a portion, the 190, but only a portion of it went to the intercompany bonds. So I'm going to pick up that amount. I'm going to say that needs to go off the books. That's going to be the 74,860. Then we're going to have to deal with the interest income and interest expense. So I'm going to say, all right, the interest income is going to go off the books. It's going to be on there as a credit. We're going to have to debit it to remove it. Now, we calculated that up top here. So we thought about the interest income, the calculation of the interest income here with this transaction related to the income that is kind of like the intercompany type of transaction related to the interest. So that is that. I'm going to pick up that number. I'm going to say, all right, that's what is included then in interest income that we're going to have to eliminate. So I'm going to debit it to make it go down. Income is a revenue account, so it has a credit balance. We're going to debit it to make it go down. Then we have the expense, the interest expense on the other side. You would think it would mirror out, but it doesn't, because of that third-party transaction, because of that separation, the way they would be recorded. So the interest expense, and the difference is going to be, part of that consolidated gain calculation we have to deal with. So the interest expense then is going to be down here. I'm going to say, all right, we saw that on this journal entry. So I'm going to say that's going to be negative of that 5,776 that we're going to have to basically remove. And then if we think about, so now what we're left with, if we highlight this whole thing, is going to be that 3,458. And so that number, notice if I compare that to basically the constructive gain, so that's going to be, if I said this equals the sum of this 3,458, that's kind of like the plug that we need, and we subtract those out. Then we've got the difference, which is that 494, which you'll recall is that 3952 divided by the number of periods 8. So that's going to be the 492. So that's going to be our difference, which we're going to apply out. We're going to apply that out to the net income portions, controlling, non-controlling interest, income from S, and the non-controlling interest in S. You'll recall that also we dealt with basically that difference in our first journal entry with the 494, when we had the adjustment to basically the net income and the book value adjustments here. So we're going to go back on over. I'm going to say, all right, so that's going to be having to do with that. So I'm going to do that this way. I'm going to say, let's pick up the investment in S, stock, and the other side being the non-controlling interest. And I'm going to do it this way. I'm going to take, all right, let's take the negative sum of these items and multiply it times, we're going to be picking up the 75 for the controlling interest side. And then we could do the plug formula, or I could do the same thing just to give us a little bit more clarity if you're looking at this in Excel. I'm going to take the same thing and times the non-controlling interest, which is the 25%. So there we have that. And then if I was to add that up, that should be in balance. That looks good. Let's post this out. We're going to say the bond payable is here. We're going to say that is going to go down. Now, it doesn't go down to 0, of course. Not even that 190,000 goes down because there's more bonds out. and we only had a portion of those bonds that were even issued that were intercompany, the premium is going to go down. Once again, it's not going to go down to zero because only the portion of the premium related to the intercompany bonds are going to be removed here. Then we're going to be going to the investment in the bonds. So the investment in the bonds, this one should go to zero because that full investment is an intercompany. It's investment in S bonds. Then we've got the income and other, so the interest and other income. Interest and other income is going to be reduced. Obviously, there's more in there than just the intercompany interest, and then the expense and other expenses. We're going to reduce that. Then we have the investment up top, the investment in stock. So I'm going to say F2 plus F2. That's going to be the 2594. And then we've got the non-controlling interest down below, F2 plus F2 for the 865. So there we are. Now, this is at zero. It's a rounding difference of $1, so I'm okay with that. Hope you're okay with that. And then we've got the retained earnings. This is the retained earnings basically reflecting on the consolidation, the parent side, removing basically the subsidiary numbers, bringing us basically to the parent numbers. These two accounts looking good. And then we reversed basically the portion of the bonds that are intercompany bonds and the intercompany investment in the bonds.